Okay. The question you should be asking yourself at the end of that PM speech is, if going public was good for these companies, why wouldn't they do it? These companies are profit motivated, they're run by experts and skilled business people, which means that there are very specific contexts in which you might choose to not become a publicly listed company, and those are the contexts we will offend on opening opposition. Firstly though, why do companies overwhelmingly choose well about whether to go public, and why there are overwhelming forces to go public, which means there are only very specific set of scenarios that mean you wouldn't. Firstly, you get access to vastly more money and more capital, the reasons that opening government themselves describe. Secondly, you get far more legitimacy as a public company. You're seen as kind of a safe bet. But thirdly, I think founders often want to do this because it allows them to actually convert their assets into wealth. Like as a founder, you don't actually get to actualize any of the benefits of holding your kind of privately owned company. You cannot sell any of that. But the point at which the company becomes publicly listed, you get to sell shares. You get to kind of create wealth for yourself. So I think I should prove that overwhelmingly companies of this size want to go public, and there are a set of 5 important contexts in which companies might choose to not become public, and we will defend those. Firstly, they might choose not to become public because they want to avoid the short-term pressure of stocks going down as a result of R&D investments. First premise here is that the market punishes any dip in kind of stocks or any sort of large costs. This is for 3 reasons. Firstly, we think often the investors are pension funds or large institutional investors, which are employed to manage large amounts of money. And importantly, they're incredibly risk averse because people don't want to lose their retirement savings, and these institutional investors don't want to lose their reputations. Secondly, they use a lot of data and algorithms, which means that it is extremely competitive, and you need to find a very small edge to find where one company is slightly overvalued or undervalued, which means that they are very risk averse with any dips. But thirdly, we think on the level of private individuals, they are obviously just extremely risk averse with losing their money. They aren't necessarily fully rationally informed, and they just kind of get very scared when companies announce large expenditures. Secondly then, why do we think these long-term investments do cause these dips? They might say, well, the market likes research and development. Firstly, we think maybe even if they like the idea of it, they don't like the cost. So it's when when companies announce on their financial statements huge amounts of losses and never returning a profit. But secondly, we think that given the context we've already given, that many of these investors are kind of very scared of risk and speculation. They actually don't like these things. So what are the harms? Firstly, it just means that when these companies become public, they're less likely to do R&D. These are the most important innovations because they transform entire industries. Secondly, we think that you are even if they do R&D, you are devaluing good firms. You're giving good firms who are doing good R&D less capital to do such R&D, which also hurts innovation. The second context is firms that might want to restructure privately. Importantly, Dell did this. They went private for a period of time so they could restructure. This restructuring looks like many of the things that private equity does. So taking on debt, shutting down entire departments, laying off large groups of workers. The problem with this is that when you're public, it has a signaling effect to the market that your company is not doing well, which means that investors get scared and stock prices go down. Even if it's necessary for the health of the company in the long term, it has a signaling effect, which means that the shares go down. What are the harms then? Firstly, we think this causes contagion, which means there are huge sell-offs when companies do things like restructuring. And that incurs all of the harms that Arwyn talks about, because people lose their pensions, people lose their life savings. But secondly, it just means that companies do not do restructuring in the first place, which is incredibly good, incredibly important for their kind of long-term health and innovation. Before I get on to the third scenario, I'll take a point from closing, from opening.
Yeah, a lot of the mechanisms of giving rely on people being so unaware of the way that these companies would work. Often in industries that have big R&D investments or that would require restructuring, people are aware of that because they see that and recalibrate their investment into the long term.
Yeah, I don't think it necessarily relies on unawareness. It relies on kind of lots of awareness, lots of data, lots of algorithms, and always trying to find a competitive edge. So when one company is restructuring, the other isn't, and you go for the one which isn't, which obviously hurts restructuring. Thirdly, you might want to protect proprietary or sensitive information, and we think that going public requires revealing financials or risk exposures, which necessarily reveal some of this sensitive information. They're going to say patents. three responses. Firstly, often patents are in relation to specific designs, not the general idea, which can still be stolen. Secondly, often these are in relation to ideas that haven't been fully developed yet, so you don't actually have the full version of the patent, it's just kind of the initial stage. But thirdly, these companies are scared, they're motivated by fear, because innovation often has extremely high costs and relatively speculative reward, which means that even if you have a patent, you're just scared of losing your proprietary or sensitive information. What are the impacts we claim here? Firstly, we think that we protect innovation and we protect the incentive to innovate because they simply will not innovate if they're scared of losing this information. But secondly, we protect national security in many cases because, for example, a US firm losing information about semiconductors to a Chinese firm might be very bad for their national security. The fourth context in which this is incredibly important is for employee-owned firms. So an example of this is IKEA, who reinvest any of their profit into wages. And we think that these employee firms simply cannot exist anymore. Employee-owned firms simply cannot exist anymore if they are owned by the market, because the market simply has a profit incentive. And even if this makes firstly, even if this makes these companies more productive, it is just deviant from the norm, which means that investors kind of get scared. They don't really like this. But secondly, definitionally, it can't exist because all the profit is just going back to the employees, and shareholders need profit. That is what gives shares value. So this gets squashed by capitalism. It gets squashed by competition mechanisms. And these are really good firms. They're good firms because they help employees rather than helping investors, who are just more vulnerable, more important. If you have money in the market, you necessarily have some level of wealth. But employees are the people we should protect. It's incredibly good that there are a set of companies that give their profits to these employees. The fifth and final context is you might be scared of compliance costs. So being public just means you have to do things like comply with ongoing audits. That requires a lot of administrative, it is hard in an administrative sense, but also costs money. So the impacts here are twofold. Firstly, I think these compliance costs are just very expensive, and you are weakening these companies at the point at which you're forcing them to comply. But secondly, I think that in the worst case, companies just literally avoid getting over that $1 billion threshold in order to become large, which creates a really weird market incentive where companies at the $900 million mark are all medium-sized enterprises trying not to capture more of the market, which creates weird inefficiencies in that section of the market. And then this debate, you should believe that companies make good decisions. They almost always want to go public, and they have good reasons not to. Proud to stand at OO.
Go. I'll start by explaining why we deliver more, better, and more groundbreaking innovation. This is trivially the most important impact in the debate. Firstly, because this is what we want markets to do, and secondly, because it creates all the modern appliances that we are able to enjoy for cheaper. TPM says we haven't named any companies, so let's do that. The first thing to say, it looks like companies like Moderna creates the Moderna vaccine. It looks like SpaceX and Blue Sky, who are innovating the vanguard of space technology. It also looks like companies like Dyson, which consistently creates innovative home appliances that all of us are able to enjoy. Obviously, public markets are capable of some kind of innovation, but our claim is that the innovation that public markets are good at are the cosmetic, incremental, and iterative kind, not the ones that are groundbreaking and transformative. It looks like Apple making the 17th iPhone instead of making a new product that could be the next iPhone. That is our claim. Our claim is that innovation, the truly important kind, takes risk. Public markets do not reward risk, they reward reliable returns. What are the responses that we receive from opening government? The first thing they say is, why do stocks matter? I would just want to note as a debating observation, the debate, for any of their benefits to accrue, they would have you to believe that the stocks matter, because the debate only has any change if you believe the stocks impact corporate behavior. But there's a number of very obvious reasons as to why stocks change corporate behavior. Firstly, because stocks impose a legal obligation to the shareholder to provide fiduciary returns. Secondly, because you can use things and your stock value to leverage things like debt, which can help you expand. And thirdly, because shareholders control the board. They can fire the CEO. That has enormous implications on management. Their way around this is to say, oh, well, the owner can maintain majority share. First of all, still undercuts the benefits that they want. And second of all, that's still not often enough. For example, if the shareholder owns 70% of the stocks, they meaningfully hold power. Why would you invest in that company? You wouldn't invest in another company, which creates the race to the bottom effect, such that companies have to maintain an equilibrium position where shareholders do have meaningful say. Also, a lot of companies have, for example, disclosure requirements. That looks like things like, even if you have the nominal majority, you need to have a supermajority in order to have decisions. That's why that argument is not enough. And obviously, it needs to have any benefit to occur. Obviously, stocks impact the decision-making calculus of companies. Come on. Their next claim, very curiously, is to say that the sets of companies that are currently in the private market are very stable. Now, and they're kind of tricked to kind of prove this, is to say, well, they're so stable because they don't need the public money. That's not our claim. Our claim is that these companies are private not because they don't need the money, it's because they don't want the public attention. Obviously, what they're doing with money in venture capital is risky. They are taking gambles. So you believe all of their weighing is to say, we want markets to be more diversified, we want them to be safer. These are the worst companies to invest in, because they are the companies shooting for the moon in order to create a new product, and they're shielded from the public market in order for them to take those risks, which is why all of their mechanisms bizarrely point to opening opposition. Their third thing to say is they say, well, the investors that predominate the public market tend to have very large risk appetite. So the question I have for opening government is this: who's more likely to have a larger risk appetite? The average Joe or private equity or venture capital? Obviously, it's venture capital, and we get more of those guys, whereas in their world, the guys largely making those choices are the average Joe. It looks like pension funds, who, as Will explains, do not want companies like big tech companies making huge bets, because that's not their business model. Their business model is to deliver safe, reliable returns in order to beat inflation. Those companies do not want, these investors do not want these companies making risk. And we say that even if there are some risk-taking investors on the margin, predominantly, the unfortunate trend is that a lot of those people are people who are not necessarily the most savvy. It looks like, for example, people who are empowered by platforms like, for example, like GameStop, like, can't think of the name, but it's like, it's now easier to make bets on the stock market more than ever. Those people respond immediately to any fluctuation in price. Those are the least likely investors to be irrational. So they take risks, but they don't take risks very well, which also activates our claim. That, I think, rebuts the vast majority of what they say. The last thing they say is some kind of like, oh, this will create a threat in terms of monopolies, antitrust kicks on either side. I'm not sure what that argument was about. So, we very clearly deliver innovation, and we've explained why that's most important. And also, we explain critically that we create two separate markets for investors to play with. If you want safe returns, invest in the public sector. If you want risky returns for high rewards, invest in the private sector. We create two different playgrounds, which means we cater for the risk-averse people that they care about, but also our sets of investors, they don't cater for both, which is another reason for why our impact is far more important. Before I move on, yep.
Why is the de-risking that companies do, like not doing your core R&D functions, rather than like financial de-risking?
Sorry? No, I don't really understand. So it's like, obviously, like, yeah, so a part of it is like R&D. I'm going to deal with the kind of financial disclosure stuff now. So the second kind of thing that Will explains is the fact that it's very important for companies to, rather than scare the shit out of the shareholders and create a potential market contagion, which I think will respond to the POI, in fact, just privately off the list, do some restructuring off the books so that you don't create that same kind of scare. And that's really, really important, because I'm not sure how opening government's information transparency claim works. I'm not sure how they imagine it. It's like, oh, we make a decision that this company is not going well, I guess I don't buy in that company. The real-time implication of that is that that spirals into a market panic, because if you sell out, that means your share price, if you remain buying it, also goes down, which means more and more people sell, and that creates a negative feedback loop, because companies that are already not in a great position because they need to restructure now suddenly have their stock value plummet, which creates a self-fulfilling prophecy, which precisely results in companies going bankrupt when they could have restructured instead. The sort of implicit response we get to this is the idea that, well, private equity, which is our comparative, are bad, they're vultures. I just want to firstly note, like, they attack private equity, but they don't attack venture capital, who do all the good stuff about innovation earlier. But specifically in private equity, there's a couple of things. First of all, the owners have to agree to sell to private equity in the first place. So it's like, why would you sell to them unless you believe that you weren't able to extract return and value out of the company? In that sense, private equity is not the vultures. They're the only company, they're the only actor providing the lifeline for these companies, because the alternative with these companies declare bankruptcy, which means more people lose jobs, because everyone loses jobs, as opposed to 20% of workers who might be cut in our world. And that means that even when you're talking about deeply distressed companies, it's far better that we allow them to restructure, as we know they do, rather than be just entirely viciously torn apart by the ravages of the free market. The last observation I want to make, and this team bizarrely concedes this, is that they point out that, like, there's only like 20% of companies that are 1 billion max out of the public sector. In which case, where is the margin for any of their benefits, right? Like when they say things like, oh, we want to democratize access to investment, they already have like trillions of dollars in the S&P, right? Like, why do you need like a handful of billion more? It's just unclear how much of their benefit they get, compared to our benefits, which are unique, which are inherent to having a private market that you can play with when you're especially a large company, which means, on another reason, opening opposition very clearly takes us to that.
Two questions at the end of the opening part. I think the first thing you might be asking, as opening opposition does, is why don't these companies list in the status quo if it's so good? I think opening doesn't make some attempts to answer that question, but I'll provide a few more which I think are more precise. But secondly, I think you might be asking, if these companies are so good and stable as opening document explains, what's the point of just like kind of arbitrarily increasing the cost of compliance on them? And is like maybe distributing that a little bit better worth the dip in value that they might experience? Closing government will explain that that cost certainly is worth it in a couple of ways. The first thing I'll do is I'll explain why companies don't list in the status quo by observing a series of things that appear as costs to them but are very good for society in general, and we should want them to kind of take on. The next thing I'll do is I'll talk about financial risk, flipping opening opposition's thing about risk aversion, and then finally I'll talk about developing countries. Firstly, a couple of costs that companies are unlikely to think is worth undergoing when publicly listing, but are clearly worth it for society. The first, relatively briefly, is just tax avoidance. I think in many instances, private companies have much larger capacity and incentive to avoid tax than do public ones, for the simple reason that public companies have significant incentives to correctly report their earnings because shareholders want them to be reported accurately, and because they want to maximize profits for shareholders. That's their kind of primary obligation. Oftentimes, private companies have a higher propensity to want to avoid the cut of tax. I think this is really important because, whether or not a company is worth a lot can be a good thing, but sometimes just means like Elon Musk gets richer. Whether governments have tax to spend on things like education, on things like healthcare, is probably pretty important. The second thing I would note, though, is that there is just kind of moral hazard in terms of companies' willingness to engage in compliance costs. Opening opposition explains that the sorts of reporting that companies need to undergo in order to make an IPO and then annually are often costly. And I would note that they accrue to the private owners of that company in many instances. I think those people are likely to underestimate the importance of that compliance for a couple of reasons. Firstly, I think the harms of non-compliance are often externalities. It's things like, for instance, not abiding by government regulations that protect the environment or labor rights. But I think the second thing is it's often just short-termist, right? Like the harms of non-compliance financially often accrue kind of speculatively down the track if, say, interest rates change, but the benefits are immediate in that someone makes a quick buck. Thirdly, though, I would note that many company owners, I suppose, have ideological commitments against compliance. They want to move fast and break things. What that all means is that corporations likely underestimate the importance of this sort of compliance. It is valuable to force them to do it, and I think that means that you are just far more likely to do things like identify wrongdoing done by your employees and be able to address it. Those are things that get missed inside opposition, and I think it's really important to provide them. The next thing I'll do is talk about financial risk. I'm going to start by providing 3 new mechanisms as to why this reduces the risk of contagion and reduces the problem of financial instability, and then I'll respond to opening opposition's thing about R&D. Firstly, 3 new mechanisms why this is better for financial risk. Firstly, we would kind of agree, I suppose, to some extent with opening opposition that it is likely that shareholders are more risk averse than private owners of companies. That is firstly because they only have access to the information reported in annual reports, whereas insiders are likely to view themselves as kind of being the goaded hired mind of the company and having a lot of information. They probably overestimate their capacity to take on risk. Secondly, investors have more diverse risk preferences and more diverse preferences about how you run a company, which means that you are much less likely on our side to over-index on one sort of risk. But thirdly, I would just note that private owners often are just rewarded for taking on large risks. They often have compensation structures that protect them against losses, but give them big bonuses when they make wins. That means I think that they are more likely to have demand for de-risking on our side of the house. But as I'll note later, I don't think it means you don't do R&D. I think it means you take less financial risks. But 2 additional mechanisms. I would note, firstly, that you're likely to have a lot more liquidity on our side of the house, kind of straightforwardly, because there are just more public companies in which you can invest. And the mechanism by which this competition improves financial stability is just that investors are far less likely to freak out and do a financial panic when they view it as easy to sell their shares onto someone else, easy to buy into a different share. Liquidity is something that meaningfully prevents financial risk. Finally, though, I would just note that regular valuations of very large companies is extremely important for keeping them accountable to banks. Private companies have the capacity to misrepresent the actual underlying value of their assets. That means that banks are just worse at lending to them. That is really important because that harms not just investors, but the financial system as a whole. I think forcing companies to regularly be valued, to undergo regular financial scrutiny is incredibly important. Opening opposition tells us the way this de-risking is likely to occur is just that you stop doing R&D because it can be risky. Here are 4 responses to that. Firstly, I think it is pretty unclear that the information provided in annual reports is sufficiently specific to throw a spanner in the works in what is clearly incredibly complex and difficult R&D. Secondly, I would say that investors are rewarded for risk in terms of return, right? And so I think they often do want to take it on. But obviously the way that investors take on risk is in controlled ways. For example, you manage a balanced portfolio where a certain percentage of shares go into risky companies. So it is just not clear to me that investors look at a company whose core business is relatively risky and demand them to stop doing that. But thirdly, I would just note that there are a variety of other ways in which R&D and the risk being taken is protected. For instance, through enormous government subsidies that allows corporations like SpaceX to put huge amounts of money that is potentially risky into R&D. And I think that is probably still pretty appealing to shareholders. I'll take opening.
Yeah, so a private equity firm that allows their projects to take needless financial risk wouldn't be well sought after. They need to be sought after. Also, how much tax does Apple pay? How well does Amazon adhere to workers' rights?
That's kind of mitigatory, right? Yes, not every company is perfect. We explain that there are more mechanisms for them to be held accountable on our side of the house. In terms of the thing about private companies who take needless financial risks, not having incentives to do that, I just explained 4 incentives that they have to do that. That's not a response. All right, quickly on developing countries. Lots of big countries are HQ'd in developed countries, but do most of their operations in developing countries. And they do fucking awful things in those countries. And those countries frequently do not have mechanisms to address these abuses. They have poor labor laws, they have poor environmental protections, they do not tax them, and so on. Uniquely, forcing them to do annual financial reporting in a developed country where they are headquartered gives you far more capacity for 3 things. Firstly, just direct regulation, because you actually know what's going on. Secondly, you are far more likely to have shareholder activism, because people who own shares in, say, Nike can go, please stop doing so. I actually don't know if they're public, but you can probably tell them to stop doing sweatshops. But thirdly, I think that they likely just experience far more reputational damage at the point where you've got a bunch of journalists at Bloomberg and the AFR or whatever pouring through their annual reports and reporting on those kind of abuses. I think these things are really important. These are impacts that affect employees of companies, that affect our financial system as a whole, that affect governments who have to bail companies out where they miscalculate the sorts of risks they're able to take on. This is far more important than the stuff we hear in the opening half about which company makes more money and so on. Proud to go.
Two extensions from CEO. First, why this makes private investors act in worse ways, and secondly, why shareholder activism is harmful to the profitability of companies. First, on private investors. This claim is debate-winning because it takes on a higher bar than our opening to rely on a set of relatively niche cases, but also it engages directly with opening government because it explains that if private investment is perhaps a little bit bad right now, it would act far worse in a world in which they were forced to sell off their companies. There are 3 mechanisms here. The first one is that I think that less private investment and less venture capitalism happens altogether. The first thing to explain here is why people do venture capitalism in the first place. There are 2 reasons. Firstly, it's because you want to have ownership of that company, which generates profits for you, but specifically you want to kind of get long-term profits from that company, especially because a lot of venture capitalism happens in tech. And this is important because usually when a company goes public, you kind of get to hold on to special shares. But if this topic requires companies to go fully public, which would mean you'd probably have to fully sell your ownership and just buy regular shares, which would give you less profit or less of a stake in the company. But secondly, it's because you want to have a controlling interest in the company, so you can kind of shape their development in a way that makes sure they continue to be profitable. But obviously you can no longer do that in a world in which it's publicly traded, because now there are many other shareholders of that company, and it's unlikely that you would maintain a controlling stake. This means then, and given that the problem then is that given venture capitalism is already a relatively difficult sort of investment industry, given you already probably make a lot of bad investments and go bankrupt and you lose a lot of money on, and you're already operating on relatively thin profit margins. This means when you now get less profit out of the big successful companies that you invest in, a lot of venture capitalist firms will just firstly go under because they're just that loss they make from all the debts that fail will be overcome by the profit that they make. Or secondly, the likely to shift to other more stable types of investing that don't have as much risk associated. The impact of having less venture capitalism firms is pretty big. There's three. First, I think it's a far bigger cost to innovation than what our opening proves, because the problem is that innovation has to start with a new firm and a new idea, and these firms have huge startup costs, which means that when they can't access large amounts of loans from venture capitalist firms, they do just go under much faster. They're unable to get through difficulties, and good ideas just disappear. That means this is a world in which we have less technology. It's a world in which we have less medicine and less of every good innovation that has happened in recent history. So that's the first reason we get less private investment generally. Second reason is that the private investment that remains acts in ways that are far worse. Firstly, it means they look like they try to extract profit faster in ways that are more harmful. Because comparatively, if you know you can have a controlling stake for longer, you can continue to profit up that company for a longer period of time, you act in ways that promote sustainable growth. But if you know that you have to sell off your share, you have to give up your ownership in that company sooner when that company is forced to go public up when they reach $1 billion, that means you act in far worse ways. That looks like firstly, you do things like cause a lot of environmental damage to access that profit faster, or secondly, you don't do long-term investments in things like research, so you need to make sure you can get as much profit out of the company as possible when it does its first initial public opening. Or thirdly, you do things like you lie, you make the company look like it's more profitable or more successful than it is to drive up the value of those shares at that initial public offering, so you can make as much profit when you sell the company in that instance, even if that is lying or even if that is somewhat misconduct, which is a problem because it inflates the value of that share and creates asset bubbles. Which is the third impact, which is that more misconduct happens generally. Because the third way in which venture capitalism will act badly is because they will try to keep their company under that threshold for as long as they can, which gives you an incentive to do sort of dodgy things. Like firstly, so just misreport your profits, just sort of not report them, try to keep on avoiding tax as closing government wants to talk about. Or secondly, do things like take on lots of debt, so you keep your net worth under 1 million, even if that might be bad for the functioning of your business, because it means you can technically remain a private company opening.
This debate isn't about venture capital because we're talking about companies past the stage of incubation, but also, obviously the incentives to misrepresent numbers occur on either side. We're the team that provides the ability to regulate that and see where it's happening if we fix it.
Okay, the problem with venture capital, so the thing with venture capital is obviously venture capital and private investment is what is all the investment is for the 1 billion. It's obviously they're in fact an incredibly important part of the debate, and the reason you continue to invest in that company beyond it reaches 1 billion because you want to make more profit off it. Okay, then talking about, I guess, the ability to enforce regulation leads to the second extension, why shareholder activism is bad, why this clogs up the courts and means that all companies are regulated worse. The first part of this extension is to explain why shareholders, the first sort of, the premise here is that once you're a publicly listed company, you are legally required to generate profit from your shareholders, and that's different because when you're a private company, you don't have that legal obligation to your shareholders in the same way. So what that means is once you're publicly listed, your shareholders can prosecute you if you haven't made them enough profit, and they can actually take you to court, which is something that happens relatively often, but obviously comparatively it doesn't happen when you have private investors because there's not a legal requirement, and also you can just kind of talk to them in a different way. So why is it then that shareholders make bad decisions or have bad ideas about what is profitable? Firstly, just private investors have more knowledge than shareholders, because often private investors exist in a specific field. So you have people who invest in tech, like that's what their firm does, which means they have a far better understanding of what's going to be profitable for that business or not. But comparatively, shareholders are more general, they probably hold a lot of different shares. But secondly, private investors often sort of concentrate in a few specific companies, which means they care about your company individually a lot more, and they know about your company. But shareholders will have very diverse, like the big investment firms, who are perhaps sort of the ones with the most institutional knowledge that governments talk about, invest in like thousands of different firms. They don't know a lot about your specific firm, so they might not have good ideas about what's profitable for your specific firm. So that means they don't have good knowledge to make these decisions. But secondly, shareholders want to access profit just as much, if not more than private investors, because they often want to kind of get short-term returns out of that investment. So they want to be able to extract profit quickly, which means they want you to be making profit now. But also, I guess they're also individuals who want their savings to make them profit. But importantly, they often will value profit over things like the environment, or sort of maybe more altruistic goals that the founders of a company might sometimes have, but shareholders will never have because they only ever care about profit. So that just shows you then that shareholders have bad ideas, and the court cases that they bring are ones that are unnecessary. What are the harms then of shareholders bringing lots of court cases against companies? Firstly, is that the court cases are incredibly expensive. This is just a waste of money for the company. They have to hire lawyers to defend themselves, and that obviously means they're wasting, they're kind of operating less efficiently and generating less profit, which is worse for the company and worse for the market. But secondly, and more importantly, this hugely clogs up the court system. And that is important because it means that real misconduct doesn't get prosecuted as much. It means that cases happen far more slowly, and it means that all regulations can't be enforced. This is how we flip opening government on the regulations and transparency claim, because the problem is that when you have all of these useless shareholder activism cases in courts, that takes away time that the regulators could use to actually prosecute misconduct that's done, because obviously these sort of systems only have one kind of court to do these sorts of things. But then the third mechanism here is that when you have more public companies, that does just hugely increase the workload on regulators in a way that means that I could miss a lot of other problems that happen. Because the problem is that this debate is not just happening in the West, it's happening in the shareholder listings that occur all around the world. Like, it's all around the world. And in a lot of places, there's a lot of firstly pressure to defund regulators or regulatory courts, which means they don't have a lot of capital to like investigate companies as is, who obviously have more financial capital and more ability to get good lawyers. But secondly, it just means the courts often have a relatively limited in size. They don't have that many judges, which means they can only get through so many cases at a time. And obviously these cases are very highly complicated and technical. So the problem then is that when you have a large increase in the amount of publicly traded companies, that means they have a huge more like companies that they have to monitor, and they have to like check their audits and things like that, which just means they do a little bit worse of a job of regulating everyone else. This may seem like a small impact, but I think it's a pretty clear one. It just means that the regulators are firstly more likely to miss other misconduct that happens because they're too caught up in regulating all these newly emerged public companies that exist. But it means that secondly, corporations are able to get away with things like making bad financial decisions, like doing risky investments or taking on risky debt. Or thirdly, doing things like causing external harms, doing things like exploiting their workers or exploiting the environment. So this flips the opening government claim about regulation, because yes, maybe more information exists. It would be great if we could act on that, but unfortunately in the majority of the world, the capacity to regulate based on that information does not exist and would get worse when you had to regulate more companies.
The first thing I'm going to do is explain which companies do this and whether it's good or bad for the market in general, which I think neatly defeats a lot and wins us today. Then I'm going to deal with CEO's claims and how extensions defeat them. Alright, first, what companies do this is what they're doing good or bad for the market. OO explains, I think, basically three contexts in which companies do this. They say they do it for good reasons, and it's good if they stay private because consumers are scared and risk averse. They say firstly, they're doing it because they're doing R&D and innovation, which now they can't do. I think Ellie responds to this, but I'll just add a few more responses. First, I think they probably just aren't doing super scary stuff at the point in which they're worth $1 billion. Like, I think the vast majority of innovation occurs probably in your nascence to some extent. Like the examples they give about, like pharmaceuticals companies and stuff like that. Like the reason why AstraZeneca became popular is because it created the COVID vaccine, which happened when it was in its nascence and not yet worth $1 billion. Probably means that that is unaffected by this debate, but also Ellie explains that things like patents are probably just not part of public disclosure. But second, I actually think there are a set of reasons why people are probably okay with research and development. There are different investors who have different appetites for risk. Not everyone is an individual who buys the S&P 500. This is probably just not that important. The second thing to say, the second context they point to is that, people want to do things like restructuring. Two responses. First, I think this can just often be explained in ways that are relatively PR friendly, so probably just don't scare shareholders that much. For instance, like we're doing some reorganizing which will help the company actually be worth more and will be beneficial for you. Like the examples they point to are like the company's in the shit, bro, like we need to fix stuff. Like why wouldn't shareholders want you to fix things? Like they probably want to hold on to the stock until it becomes more valuable rather than short it at a time in which shit is going badly. But second, I think if it does look a bit sus, like if companies are doing sus things, maybe people should just know about it because it means it signals the need for government to do more regulation of that company, or maybe they get pressured into doing things like a merger or a buyout, which is probably a good thing for this debate. The third context they point to is that if you're uniquely structured, like for an employee-owned firm, there are two responses to this. First, I think these firms probably have uniquely perverse incentives. For instance, like maybe employees are not buying enough capital in the firm and not making it be efficient because they just want to keep their wages really high. So it's probably unclear that these are intrinsic benefit. But second, these people probably benefit from things like an IPO in ways that they don't have expertise to realize. So actually the enforcement of this is probably a good thing. But I think even if you believe that the companies they talk about suffer a bit because people don't have a sufficient appetite for risk, our extension defeats this in two ways. Ellie explains why risk aversion is okay. Firstly, because the downsides are far too high, regardless of what the company we're talking about looks like. Like the possibility of that should be weighed a lot higher because the downsides are enormous. But second, I think Ellie neatly explains why these companies are actually likely to be maybe financially solvent, but incredibly sus in a variety of ways. For the reason that the opening half of this debate explains, like it's financially worth it probably to go public. So if it's not what OO talks about, why the fuck else aren't you public yet? And we point to two instances in which this happens. First, maybe you're hiding something, you're trying to avoid tax or do something a bit sus, or you have a weird sus relationship with the government. Or secondly, individual people in the company have too much power, like ideologically. Like these are the contexts we're talking about. And I would suggest that these are numerically the majority of companies we're talking about in this debate for two reasons. First, it's a much easier thing to do to like cook the books rather than create a new patent and be really smart and do like lots of really awesome innovation. It's a thing that lots of people seem to be inclined towards because it's a relatively common crime. But the second thing is like those sets of people who are maybe like ideologically very tied to it or want a lot of power are the people who are selected for when owning these companies. Like you have to have some cunning street smarts to go into finance, and the reason why you're still involved in the company is probably because you have like a strong vested interest in it, or were part of the origination of the company, or a founder, want to keep your control over it and its vision. So these are numerically probably mostly likely to be sus, and this is by far the biggest impact in this debate, rather than keeping the R&D private for a while. Firstly, because it has the most direct effect on contagion and risk. Because it's very easily linked to institutions. Like Ellie explains, for instance, if you have an overvaluation of a company, and now a bank is a little too inclined to give you money, and this can't got around through regulation, because the government also thinks you're worth quite a lot of money, like that is really bad, because banks don't have enough money to give back to their consumers. That is the most direct way in which contagion occurs. And this just looks like big firms losing huge amounts of money, having huge flow-on effects, because they also get money from banks. This looks like individuals losing their savings. That is clearly the benefit that OG was going for, but only we mechanize. We defeat our opening for two reasons, then I'll get to you, Brendon. Firstly, because we just take a higher burden. Opening is like, well, no, there's like basically no explicable reason for why these companies are still private. We're like, sure, there's an explicable reason. We just explain why it's probably a bad one and why we should be willing to cop the risks for them going public. But second, we are more precise in how, in explaining how this leads to contagion. OG is a bit removed from this debate. Like maybe the AI bubble has some other factors that are going into it. And Arwyn just says that financial transparency is good for individual capacity to make decisions. But we explain two things that are unique to this that are more important. Firstly, what it actually looks like. Like Ellie talks about developing country context or the enforcement of paying tax and stuff like that, which just is more specific and actually relevant to this debate. But second, we actually tie it to financial institutions, as I just explained, which are one, the most proximate way that contagion occurs, but second, the most informed person who can have flow-on effects to other contagion. Like if a financial institution loses its faith and stuff, then individuals also do it. So we have a higher impact than OG does. Take you, Brendon.
Yeah, so the externalities associated with a bit more tax money pale in comparison to externalities of green tech and medicine. Also, how do public investors in your world de-leverage financial risk without causing a wave of sales, which drops the stock price and then causes another wave of sales? That's our main concern.
Okay, so the first thing you're like is like, oh, well, the upside of research and development is really high, the downside of tax is really low. Like, I don't think that's true. I think there's probably quite a lot of tax that they're not paying, or maybe they're doing a bunch of other things that Ellie explains that are really sus, that actually do have really high impacts. I think we explained that. But second, I just don't think it's particularly likely that the research and development is that important or that revolutionary, otherwise people would just be okay with it. Like, it's so unclear to me why investors are so illogical. I think Ellie pretty much explains that. I'm going to move on to CO. CO says two things. First, they say that private investors will act in worse ways. There are two responses to this. The first thing to say is that the incentives for venture capitalism exist before the timeline of this debate, because they invest at the point at which they're sort of starting and they can earn a lot of profits, but they probably sell before the IPO, or even if you believe they hold on after the IPO, it's okay for them to hold on a smaller stake in the company because they need the rest of their capital to go invest the money in another firm and then make a huge chunk of money. So it's clearly not about them. But the second thing to say is it is unclear the speed of profit is directly associated with how bad your actions are. Like, you can have bad long-term incentives, for instance, gaining a monopoly in a developing country, as Ellie identifies. We're the only team that explains actually why we can regulate. The last thing CO says is shareholder activism is bad. Like, just fucking intuition check this. Like, they're not going to be wasting their money. They probably won't have a case if they do it in frivolous ways like Maya explains. Obviously, Ellie's explanation gets overlapped.